Hello, everybody. It's Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, also known by many of you as Mr. Valuation. It's once again my extreme pleasure to welcome you to a Subscriber Request Tuesday series that I've been doing for some time now. And this is a particularly interesting one for me, at least, and hopefully for you as well, is because I did have two subscribers on my last video, YouTube subscribers on my last video, asked me to look at the company APAM. And I guess it's Artesian Partners, and I'll get into that here in a moment. But I want to give a shout out to AZ, who had this, excuse me for reading. Hi, Chuck. Thank you for this very informative analysis. Could you eventually have a closer look at ticker symbol APAM, Artesian Partners Asset Management, Inc., and integrate it into a video? Now, he got 7 likes on that comment. And then Ed Jordan, I want to also give a shout out to, another subscriber, said, I second this. It's another stock that I really like and want to increase my position in, but inexperience makes me hesitate because more people don't like it. I'm learning to trust the process. Well, those are some very interesting comments. And let's go ahead and dig in. Now, what's really interesting about this particular company is one that I'm not familiar with. In other words, I personally have no experience with this stock. So what's going to be interesting about this video is I'm going to be analyzing it kind of on the go. All right. And I call these analyze out loud videos. I'm going to be analyzing the stock for my own personal edification, as well as sharing what I find with you. And I want to and it's kind of an interesting story because at first glance, there's a lot to like about this stock, but there's also some risks that I want to be sure and cover as I go through this video, and some things that I think you should be aware of and kind of go through the process. Now, I also want to throw in another caveat. I am not ready to say this stock is a buy at this point, and I'm not ready to say it's not a buy at this point. In other words, this process, to quote Ed Jordan again, that trusting the process. I'm going through the process here, and I do believe that beyond even what I've discovered so far with this video and what I'm going to share with this video, I still have more work to do on this company. Okay. So let's start by looking at the basic fast graphs, and let's point out a couple of things that really caught my eye. Number one is the blended PE is 11.75. Okay, that gives it an earnings yield of 8.51, which certainly meets my criteria of at least 6.5% to 7%. It's above that. The dividend yield is 7.11%, but that dividend yield is kind of tricky, and I'm going to get into why I consider it tricky here in a few moments later. But anyway, I've got a good valuation from a PE standpoint. I've got a good earnings yield, and I've got a really good dividend yield. Now, the company has 56% long-term debt to capital. It's not rated, and it's what I would call a small cap. It has a market cap of $3.3 billion, a total enterprise value of $3.2 billion. So this is a small company. All right. Now, a couple of things that I learned by looking at the fast graph that I found curious, and I dug a little deeper, and I'll give you some explanation of this again as I go through this presentation. But the first thing I wanted you to note is that when you look at, I'm going to take the price off the graph here so that you've got earnings per share here, and I'm using operating earnings. Now, by the way, I can also look at basic earnings and diluted earnings, and those are different metrics, but I'm also going to be looking at cash flows and free cash flows. But the first thing I see here is that earnings are not covering the dividend. That's very, very unusual. The dividend payout ratio for this company is very strong. It was over 100% in 2016. It was 81.6% in 2018, and back up to about 95.7%, et cetera. So the first thing I noticed is the earnings aren't covering the dividend. A little bit later, as I mentioned, I'm going to show you why. The dividend has been really kind of interesting as well. The first year's dividend was rather small, it was 86 cents, but then they've been paying a $2 plus dividend for up through 2020, and now that dividend has increased to over $4 a share. But something interesting about that is this company declares a regular quarterly dividend, but then they also pay special dividends, which is what makes this tricky. And I'm going to go through that for you again in a little more detail. But this is the first thing that really kind of troubled me. I don't like to see, payout ratios being that high. Now, I want to talk about performance. Let me put price on the graph. When the company went public back in March of 2013, it initially came out with a nice surge, as you can see, but that got the price significantly overvalued by my edification of, a PE ratio of at least 15. And then that was during a period where we had two really good years of earnings. We had 38% growth and then 25% growth. Then we had 2 down years of earnings. Now, the company was still profitable. That's important. But earnings went from 317 to 269. That's a 15% drop. And then they fell another 21% to $2.13. And then they started rising again. But then we had another down year of only about 9% in 2019. Of course, we probably know what that was about. And then earnings are 25% increase in 2020. And then we're estimating 511 and 550 for this fiscal year, which this company does have a December fiscal year. And then we see this kind of weird dividend record as well. It was 220, 240, 240 up through 218. Then it dropped to 236. That's with the drop in earnings there. And then we saw 279, and now we're expecting 489, 512, and 562. Now, according to NASDAQ, I found this very, very interesting. NASDAQ is a very reputable site, but I'm going to go ahead and bring in their site here and look at APAM's dividend history, because I want you to notice some discrepancies. One is they only give the dividend yield of 6.86% and the annual dividend of $4. Okay, now, when you look at their dividend history of the company that they report, I want you to note that they do declare regular dividends quite often, but then they also, typically in February, they also issue a special dividend on top of their regular declared dividends. They've done that in February of 2021. They did that in February of 2020. They did that in February of 2019. And they did it in February of 2018. Now, I want to look more into that. I'm not sure why they picked February to do that, but that's why I say the dividend record of this company is a little tricky. It's not just a straightforward, dividend. If you noticed on that NASDAQ chart I just showed you a minute ago, they say the annual dividend is $4. And of course, we've got 489, 512, and 562. Now, I've checked other sources, and you're getting, these numbers corroborate with other sources, as do the earnings estimate. For example, I checked some Standard & Poor's data. We get our data, of course, from FactSet. These earnings estimates are in line with what Standard & Poor's has. There's just a penny or so difference. But, the bottom line is the company is expected to grow pretty fast this year and then slow down to about single-digit years after that. So that's something important to look at. But I want to talk about performance a little bit. Again, I want to go back to the overvaluation. So I'm going to look at its entire history to start with. And again, you see these dividend records, and you see the dividend cut here. Then you see the dividend increase here, and now we're starting to pay about $1 a quarter. It's going to be about $4. That's what this is, 1 quarter. So again, it's a tricky dividend. But if you look at it without reinvesting the dividends, the company threw out 4,983 dividends. That's more than twice what the S&P did, but it dramatically underperformed the S&P during this time frame, but still gave us a respectable 7.4% rate of return. Now, I'm going to play some different strategies here, because when you look at the long-term performance, the S&P did better except for the income. This did pay a lot of income. So let's drop it to a 10-year graph. And now we still have pretty serious overvaluation. Let's check performance again. Now we've actually got a negative capital appreciation, better dividends than the S&P, but we end up with virtually a break even, if you will, 1.1% annualized total return. And again, I would attribute most of that to the overvaluation, coupled with some down years in earnings, which even brought the valuation down significantly more. But now, these are technically fairly valued, but they're not. And I want to make that point, because the reason they're not is because even though this would technically meet my, earnings yield criteria, PE of 14, the earnings were dropping. Okay, so you've got to have a 6.5% to 7% earnings yield with an expectation for at least maintaining earnings growth, but preferably seeing some increasing earning growth. That's a very important principle that often gets overlooked. But let's take a couple more years off the graph. Now we've got the stock fairly priced, but we still have this down year of earnings. We've got operating earnings growth of 10.15%. And let's go back and visit all of that. We have 11% earnings growth here. So earnings growth has been strong, but that's based on a very high estimate. I dropped it to the 8-year. We were down to 7%. And now I'm going to cut a couple of more years off here. And now we've got the stock where it's fairly valued with earnings growth of about 15%. Now, when I run performance here, I get a much better comparison to the S&P. I get significantly more dividend income. I get double-digit growth, 12.8 versus 17.3, but I make almost as much money total return as the S&P, just slightly less, but I did get a very nice amount of dividend. So as an income investor, this could be a very, very interesting stock. Okay, but I'm going to continue to play this game a little bit. I'm going to go even more here. Now we've got the last couple of years, okay, where you've got this big surge in earnings factoring in. So at this point, if I look at it more recently, so long term it's been an underperformer. More recently it's become a equal performer to the S&P. And now if I run it over this short term time frame, it's become a significant outperformer against the S&P, generating a 45.5% annualized rate of return versus a very strong 21.4% for the S&P, I might add. Okay, so you always want to factor in, and I always say measuring performance without simultaneously measuring valuation is a job half done. By the way, you also have to add in growth, okay, because growth is a significant part of this whole equation. All right, so let's go ahead and look at forecasting a little bit. As I mentioned, we have a $5.11 forecast for this year. 6 months ago, it was $4.76, then it increased to $4.80 and then to $5.05. So now we're at $5.11, so that's a good sign. We're seeing a steadily rising increase in analyst estimates. And likewise, we see a very similar pattern for 2022 where estimates are going up, but yet we see a little bit slightly different story for 2023 where the estimates have actually fallen from 656 down to 583, and they were steadily dropping during this period, but then they've kind of reaccelerated again over the most recent estimate. So we've got that, to deal with here, just a little bit. But having said that, this stock looks like it offers really great return potential. Now let's look into the company a little bit just to get familiar with what we're talking about. Okay, this is their website, okay? And, they primarily serve institutional investors and investment professionals, but they also do some mutual funds and so on for individual investors. So when you go into their overview of their business, you can see that they have offices, all over the United States, if you will. They have several different investment teams and they have different investment strategies or styles. They got growth, they got global equity, value, global value, emerging markets, credit, fixed income, developing world, and so on. And then, you can also look at their investing culture and, they brag about having a value-added investment decision stem from, creative prospects. So they give you some information on the company here. Their business model is also interesting in that they break this down into teams and they have various teams that cover different investment strategies that they work in and serve. So it's an interesting company. But now I want to go in and I want to look at cash flow because one of the things that really intrigues me about it is the current dividend yield. It's 7.11%. Now I do want you to notice that NASDAQ called it a 6.86% yield. But again, that's the tricky part. These special dividends aren't necessarily, formal and etched in stones, and maybe we'll even look at more. But I've also want to point out that cash flow has been dropping, even though it covers the dividend pretty well. So their payout ratio from cash flow is a more manageable, 40 to 50%, we'll say 45 to 50% range in recent years. And of course, prior to that, it was much lower. But then I also want to look at free cash flow because that to me is the real acid test. Now it is also decreasing, but it is still covering the dividend, and the free cash flow payout ratio has been in this 40 to, we'll call it 40 to 55% range as well. So they're still covering their dividend pretty nicely with cash flows. But so, the real question then becomes, why do we have this, this earnings aberration where they're paying out, a higher percentage of their profits? Now, the company does have a policy of paying out 80% of their distributable money, I believe it is. I'm not sure. I'm still something, I'm learning about this company, so I apologize for that. But the bottom line is, and then they pay out this special dividend. One of the things that I'm looking for is I want to determine, what that criteria is if I can. But this is the part that I want you to see that relates to the earnings, okay? This is common shares outstanding. This company has been raising capital very aggressively, and they've been very, very dilutive, okay? Now, that really has several aspects. If I look at the company's revenues, okay, their gross revenues or total revenues, not revenues per share. I want to make that distinction. They've really been kind of flat. If you look at it over the last, let's say, 5 or 6 years, there's been a little bit of growth, but they've had some negative years too, because this company has suffered. One of the risks that Zacks Investment Advisory Service, which I subscribe to, talks about here is that they're pointing out that their expenses have been in an uptrend for the past few quarters. And they've also had some outflows of capital, which part of that had to do with COVID, et cetera. But this is their gross revenues. Now, when I go into their revenues per share, I want you to note that their revenues per share have been in a very strong decline, especially over, the last, since 2012. And again, I think a lot of that has to do with the fact that we've seen this, dilution at the company where they've been growing their stock count by over 12.5% a year since 2014. So they went from 28 million shares to 56. That's literally a 100% increase in share count over the last 5 or 6 years. So that really explains to me why we've got some earnings discrepancies here, or inconsistencies, or however you want to articulate it. All right, so I have a little bit of trouble with that. Now, when I look at some of their other numbers, for some reason I'm not getting gross profit margin, but I am getting net margin, and net margin is, again, all over the place for this company. But if I look at it quarterly for the last 16 quarters or so, they've maintained their margins, and if nothing else, they've kind of increased their net margin a little bit. If I look at return on assets for the last several quarters, they've been increasing, so I like that. That's a positive. Return on equity has kind of been stagnant, but increased a little bit for the last couple of quarters. And then returns on invested capital have been growing over the last several quarters. So it's a very, very interesting small cap company here that, is probably reasonably priced now, does offer a very good dividend yield. Based on cash flows, though, I do have some issues with the cash flows decreasing. But again, all this is per share data I'm showing you. And part of the reason why cash flows are dropping, as well as, earnings have been difficult, is because the company is diluting their share count. So that's something that investors, really need to be aware of. Now, EBITDA is expected to grow, and the forecast for EBITDA growth is expected to be about 16 or 17%. This would indicate that the company's reasonably priced. But anyway, this is a very interesting company. Now, they have had, according to Zacks at least, a very volatile trend in net outflows over the past several years, as I showed you here just a minute ago. And, and they're kind of really struggling with that. But for some reason, analysts are very optimistic going forward. It is a small cap. I find it very difficult to find any what I would call quality research on it, but I'm still digging. But here's how I would end this video for you. This is a very interesting little company. And again, I want to emphasize it is a little company. It does have some intriguing fundamentals. They do pay this special dividend. And again, they do have some type of process of paying out 80% of some number in dividends. And I'm going to double check that. I haven't gone far enough yet. But this is how I approach researching a company that I'm not familiar with. That was a big part of this video for you. The stock looks interesting. The statistics, if you were just looking at the numbers, earnings yield of 8.5%, PE of under 12, dividend yield of 7%, moderate levels of debt, that would be kind of interesting. And I could get into the debt levels here by going into the balance sheet, first of all, and looking at their long-term debt. But then I also want you to look at, when I'm looking at the debt, I want you to look at the cash flows, and I want you to look at dividends relative to that debt. And then I also want to look at operating cash flow relative to that debt. And, again, they're covering their dividend and they're covering their debt. A lot of their debt, if you look at it from a standpoint of, go back to the balance sheet, if I look at total debt per share versus long debt, the majority of their debt is long term. But there are red flags here that need to be looked at. That's all I'm saying. So I wouldn't get all hung up on the numbers yet. It's an interesting company. I'm going to do a little more research on it. I do like the current yield. The dividend record to me is a little bit, again, it's a little bit dicey. It's really hard to kind of figure it, but you might want to take a closer look yourselves. I hope this preliminary approach to how I would research a stock gave you some insights into the different kind of things you want to look for. Don't just look at the statistics. There is no shortcut for comprehensive research and due diligence. Fast Graphs, is a great tool that helps you determine whether it's even, worth your time to do any research, but you can't avoid doing the research and due diligence. This has been Chuck Carmel saying thanks for watching. If you liked the video, give me a like, ring the bell, subscribe to the channel if you haven't already, and you might want to take a look at Fast Graphs. We do offer a free trial that's totally free, no credit card required. You might want to take a look at that. We do limit the number of stocks you can look at, but it will give you a good feel for how the tool works. Anyway, thanks for watching. Talk to you again real soon.